Small and Minority. Hello, I am Tamla Saldana, and I am the Assistant Director for the Small and Minority Business Resources Department. You are here today, hopefully, because you have signed up for the Corridor Mobility Program Technical Assistance Workshop. We are so excited to present this particular technical assistance workshop in an effort to meet the needs of our small and minority businesses who are interested in bidding and proposing on the City of Austin Corridor projects. The purpose of this particular workshop is to build vendor capacity. Again, our goal is to have you as small and minority businesses to successfully bid and secure corridor projects as outlined in our corridor MWBE program plan. Today, we have a wealth of expertise and topics for you that we will go over to include financial statements, studies, surety bonds, and working capital. We have a host of other additional topics that we will present to you in a virtual format or in person through additional technical assistance workshops that will also provide opportunity for vendors to meet one-on-one and also have additional topics that will grow and hopefully build your capacity as a small and minority business. Before we get started, there are a few things I just want to cover in terms of workshop protocol. Again, as a reminder, if you haven't done so already, sign in the link in the chat so that we have a record of your attendance and be able to reach back out to you to market additional technical assistance workshops. We will have questions following the presentation. If you have questions, again, you can simply type them in the chat. Also, at the end, you can raise your hand using the Teams protocol tools at the bottom of that should be located at the bottom of your screen. Again, most importantly, we are recording this session so that folks could have access to it at a later time. So please mute yourself when you are not speaking. Again, I am Tamla Saldana, and I thank you for your time. And I am going to turn it over to Ms. Clotilde Davis Haynes, who is our MWBE Corridor consultant, to introduce our topics and our speakers. Clotilde.
Pamela, thank you. And thanks to all of you getting out of your warm beds. I know you were going to sleep all day. That was my plan. It's a good day to do that. But we really appreciate you joining us today. When we begin thinking about these technical assistance workshops and how we can best prepare City of Austin certified vendors to pursue these opportunities, we knew that early on, we needed to deal with a very basic requirement when you're doing work in the public sector, private sector often as well, but definitely the public sector. And that's the issue of surety bonds. For those of you attending today, if you've ever attempted to get a bond, secure a bond, and you were not successful, hopefully you were, but if you weren't, we hope to share some of the things about bonds that, or unlock some of the mystery about pursuing and securing surety bonds. As we talked about what should be covered, it became very clear in our discussions that you really cannot effectively have a discussion about surety bonds if you don't address two other very salient topics and issues. One of those additional topics is financial statements, because surety agents are going to require that you provide those. The other issue very salient to any discussion about surety bonds is working capital. Again, a surety agent is going to look for your ability to carry your job, your project. Do you have the money for the materials that you have to purchase? Do you have the money, the resources for the labor that's going to be called for you to do your work? So we are bringing you today information on all three of these issues, but as you will see, they fit together and they really work in tandem with each other. I want you to know how special this workshop is, because what we have, who we have assembled, not what, but who we have assembled to help us go through these topics are, and I want you to understand this, these are the leaders, absolute best in the industry in our area. So for financial statements kicking us off today, we will have Mr. Philip Wooten. Phil is a CPA, but he's also a partner with Rideout Barrett CPAs. He'll start us off with a discussion about financial statements and what you need to know. That will be followed by our surety bond specialist, Mr. Andrew Marquis. Andrew is the vice president and branch manager of Markel Surety. And our last speaker will be Ms. Barbara Boetta. She's going to talk to us about working capital. Ms. Boetta is the executive director of the Economic Growth Business Incubator and has been a long tenured expert dealing with small and minority women-owned businesses and providing them the tools they need to succeed. So with that introduction, again, as we go forward with this, please avail yourself to chatting your questions as we go. You something comes up, chat it in the, type it in the chat section, and we will address that when we get to the Q&A at the end of the presentation. But with that, I am going to turn this over to Mr. Philip Wooten with Rideout Barrett to talk about financial statements. Phil.
Yes, thank you, Ms. Clotilde. Good morning, everybody. I hope everybody's surviving this Tundra 2021 that's passing through Austin. I usually tell my kids when the first cold front moves through that Tundra is passing through, and they usually tell me I'm getting very dramatic and overexcited about things, and they're probably correct, but hope everybody's doing well, staying warm and dry for sure. This morning, first part of our workshop, we're going to talk about financial statements, kind of a entry-level basic financial statement 101 of what components make up the financial statements, the basic financial statements. The three main financial statements are our income statement, the balance sheet, and our cash flow statement. And then from there, we'll take a look at the types of financial statements engagements that are possible and may be required or may not be required, but we'll look at the different types of financial statement engagements. And then some common mistakes that we see when preparing financial statements. And you can see on our first slide here, we're taking a look at the income statement and the components that make up our income statement, which is revenues, our cost of goods sold, a gross profit, and some expenses, and that gets us down to our bottom line. The balance sheet is made up of assets and liabilities and equity, and we'll take a look at some examples or some sample financial statements as we go through the presentation. And then our cash flow, which basically gives us an idea of how much cash we had coming into our business and how much cash did we have leave our business. And it gives us some measure of how we're doing on a cash basis, which is important, and where the cash inflows are coming from and where the cash outflows are going. And so if we take a look at our next slide here, the financial statement, the types of financial statements that can be produced. The first set, and you can kind of think of this as like a ladder, the lowest form or the most basic financial statement we have are compiled financial statements. And compiled financial statements are very simple, they're basic. And for CPA to prepare financial statements like compiled financial statement, basically we're just taking your accounting information, we're putting it in the form of financial statements and making sure that it looks reasonable, things add up and they're in the proper categories. And there's not much assurance or there's no opinion being issued on these financial statements. They're mainly used for management purposes. A lot of our clients ask us to prepare compiled financial statements on a monthly or quarterly basis so they can review their financial statements as they go throughout the year and use that for management decisions purposes. Management likes to know, how much revenue have we done for the month of April? How much revenue have we done for the quarter, first, second quarter, balance sheet? They want to take a look at how much cash do we have on hand at the end of the month, things of that nature. Provide them some information to help them make decisions as they're going throughout the year. The most simple, basic set of financial statements are compiled. Sometimes a set of financial statements include not only the three main financial statements, a lot of times they include footnote disclosures. You don't normally see a lot of compiled financial statements that have the footnote disclosures. Again, management's not looking for all the footnote disclosures. They just want to see how well they're performing in operations and where they are concerning cash position, accounts receivable, and their liabilities. What do they owe coming up for the next month or for the next quarter? And they use that to make management decisions. The next set of financial statements we have are reviewed financial statements. And this is probably the most important set of financial statements when it comes to surety and bonds, because this is what the main requirement is. A lot of times our clients, when they're getting bonds, they need to have a set of reviewed financial statements. And another distinguishing fact between these financial statements is compiled financial statements do not require the CPA to be independent. I can do the bookkeeping and I can be more involved in creating transactions, recording transactions when I'm doing compiled financial statements. I can do bookkeeping and I can do adjusting journal entries and so forth like that. Once we step up from that compiled to reviewed and audited financial statements, we have to maintain as CPAs our independence. So it lays upon the shoulders of management to start making a lot of decisions concerning bookkeeping, adjusting entries, classification of transactions, and so forth like that. But reviewed financial statements are a little bit more involved than the compiled financial statements. It's one more step up that ladder. When we're looking at compiled financial statements, I'm taking a look at your trial balance, your accounting transactions. But as I'm putting together these financial statements, I'm also doing some analytical procedures, and I'm also doing some ratio analysis, and I'm also talking to management about the financial statements to make sure that these financial statements are reasonable and that there are really no material adjustments that need to be made. So there's a little bit more elbow grease, there's a little bit more work that goes into preparing a set of reviewed financial statements. Although at face value, when you look at compiled financial statements or a reviewed financial statement, on paper, the ink and paper, they look the same. But to get that sameness, get to the same answer when we're doing reviewed financial statements, there's a little bit more due diligence on behalf of the CPA to make sure that the numbers are materially and reasonable correct. And these are used again, a lot of times lenders will require a CPA to review financial statements for loan covenants or for bonding purposes. Reviewed financial statements are required. The audited financial statements are the next highest form of assurance. And again, when we're preparing audited financial statements, we are actually doing a lot more due diligence than the reviewed financial statements, and of course, more than the compiled financial statements. We're doing ratio analysis, we're doing some analytical procedures, but as part of auditing procedures, we also are contacting third parties. So for example, when it comes to your cash balance, compiled financial statements, you just tell me how much cash you had at the end of the bank. And to me, if that's reasonable based on my knowledge and understanding of your business, I can go with that number because it's for management purpose, management use. When it's reviewed, I may want to take a look at a bank reconciliation and I may compare last year's cash balance to this year's cash balance and do some other analytical procedures to get comfortable with that balance. When we're talking about audited financial statements, we're going to send a letter to the bank and we're going to ask them to confirm some information to make sure that that cash balance really is what's being presented on the financial statement. So when we're talking about audited financial statements, we're going to issue an opinion. We're going to issue the highest form of assurance that the financial statements that you're looking at are in all material respects reasonably stated. And so there's a lot more due diligence and a lot more elbow work to go in and produce a set of audited financial statements. In addition to these financial statements, reviewed and audited financial statements will always have footnote disclosures. So behind the three main financial statements, you will see a lot of footnote disclosures, a lot of additional supplemental schedules and so forth like that to detail the numbers on the financial statements. And we can go to the next slide. Preparing financial statements can be done one of two ways. They can be done in-house with a company hired bookkeeper, accounting department, self using, QuickBooks, basic accounting software, or they can be done externally. And that's when a company would hire CPA firm or a bookkeeping service to do the books for them and accounting for them on a monthly basis or quarterly basis. Most of our clients, we try to do, large clients, we try to do on a monthly basis if we're doing that type of service, because the number of transactions sometimes is voluminous and it's easier to keep up with it on a monthly basis. It also provides more timely information to management if we're doing it monthly rather than providing a quarterly bookkeeping and financial statements. We can run to the next slide. Now we're getting into the financial statements. The first statement we're going to take a look at is the income statement. Sometimes it goes by the common name of P&L or profit and loss or statement of operations. But basically the income statement details for us your revenue streams and then your expenses and gives us your bottom line in the form of net income. How well are we doing our job at making money? And the components of the income statement starts out with the revenue. That's, your job revenue, your contract revenues. The cost of sales is another component, and that is going to be what it takes to produce the cost to produce that revenue. Most of cost of sales or cost of goods sold is composed of material and labor, maybe some allocated cost, and any type of cost that would be associated with your contract or job cost. And that leads us to a gross profit. And the gross profit is just your revenue minus your cost of goods sold, and that gives us our gross profit. And that number tells us how well are we doing when it comes to earning revenue on our jobs. And then beyond the gross profit number, we then have some general expenses, and that's examples of general expenses would be your rent, utilities, repairs and maintenance, meals and entertainment, anything that would not be a direct labor or direct, material or direct job cost goes down into our general expenses. And we take a look at an example on the next slide of income statement. And so here we have a sample company for the year ended December 31, 2020. And you can see at the top line, the total revenues or contract costs. This is a contractor here. For the year, they had $2.9 million in revenue. And the cost of labor, the cost of materials, and some allocated cost in there was $1.5 million. So for the year, they had a gross profit on their jobs of $1.3 million. That's a pretty good gross profit percentage. And then beyond that, we have our operating expenses or our general expenses. And you can see it next to and because these statements are summarized, a lot of times we will provide in the back of our reports, financial statements, supplemental schedules. You see Schedule 1, and Schedule 4. This is the detail that provides the number on our financial statement. So we provide an itemized for our operating expenses on Schedule 4. We would list out what makes up that $917,000 of operating expenses, so that management can take a look at that detail and not just get lost with the summary numbers. And then so after you get down from your operating expenses, you have your income from operations, which is $442,000. And then we have another section on our revenue, other income and expense items. And this is important for the main reason we have miscellaneous income of $42,000 that's not associated with our revenues, our main source of revenue. And we don't want to lump that into our main source of revenue. We want to separate some of these things so that we can keep an eye on how much money are we making from our main source of business. And there may be throughout the year some ancillary or some small amounts of income that come from miscellaneous sources or expenses like interest income. It's not part of our job revenues. So we separate that out. And then we have a calculation for income taxes. And then at the bottom line, our net income, which is what everybody's looking at when it comes to our profit and loss or income statement, and the net income. And we can go to the next slide. Our balance sheet is composed of really two sections, the assets, the liabilities, and equity section, and we can go to the next slide. And this is a sample of what our balance sheet looks like. We do 2-page balance sheet. The first page details out the assets. This is what you have at the end of the year. And again, you can take a look at cash on December 31st, how much cash, how much did our customers owe us in accounts receivable, and then, another category, property and equipment. And so at the end of the year, our total assets about $1.2 million. And these are the things that our company has possession of or owns. And then we can go to the next slide, which shows us our liabilities and our equity, or equity may be another word for net worth. You can see the current liabilities are what we currently owe in accounts payable. That represents vendor payments, utilities, material costs that we haven't paid. We may have charged or haven't paid the bill just yet. We got it in, but haven't paid it. And then some other accruals like state tax payables and other accounts that are going to be due within the next 12 months or form our current liabilities. And then we have a section for long-term debt, deferred taxes. And then at the bottom, we get down to our stockholders' equity or our net worth. And then our total liabilities and stockholders' equity at the bottom total, $1.2 million. That should equal what is on our assets, our total assets. Those two numbers equal. And when we talk about common mistakes, that is one common mistake that we see, that those numbers don't equal. And that's something that we need to fix when we're preparing financial statements for clients. Want to make sure those numbers equal. And then we can go to the next slide. Here, a cash flow statement. And then this, again, just gives us an overview of how did we do from a cash standpoint. How much cash did we have coming into the company? And how much cash did we have going out of the company? And we can take a look at that sample statement. And here we go with starts with our net income of $288,000. And this is a really difficult statement sometimes to calculate, because you have to make adjustments for non-cash items and add that back or subtract that depending on the type of non-cash item. But basically the goal is to determine how much cash did we make or spend during the year. And we break that down into various categories, one being our operating section. And you can see down about middle of the screen, we have a title here, or caption called net cash provided by operating activities. And you can see that number is around $96,000. So that tells me that for the year, our main operations generated an additional $96,000 in cash. And that can be a good thing. And then we have another cash flow from investing activities, which we spent $19,000 on purchasing some property and equipment. And then we had some cash flows from financing activities where we paid down some debt in the amount of $10,000. So for the year, our net increase in cash was $66,000, the majority coming from our operations, which is good because that's where we want the majority of our cash coming from, is from our operations. If we see cash coming from our borrowings, like lines of credit or debt, that may be assigned to management, that operations is not performing well and we're relying too much on maybe credit as a means to cover our expenses, and management may need to make some appropriate decisions on operations side. And then we can go back to our next slide here as we take a look at some of the most common mistakes that we see are going to be math errors. A lot of times software produces financial statements, but they don't always produce it in a format that is proper or correct. And so a lot of companies, even we convert those into an Excel schedule. Clients do this as well. And sometimes the columns don't always, or the rows, the columns don't always add up. And so there's math errors. And so part of what I normally do when I'm reviewing financial statements is I go back and I manually add everything up on a 10 key. I love my 10 key. And I'll do that to make sure that everything adds up properly, that, sometimes there's formula errors. We don't always get all of the right cells in the formula. And so it creates a math error. And so those are some common mistakes that I look for. Another area, notation or labeling errors that we see, and that's just putting things in the wrong category. Like if you have property and equipment put into your current assets, that would be a mistake on a financial statement that we would look to correct and make sure that everything is in its proper category on the financial statement. And that is useful because some banks, some bonding agents look at ratios and they use financial statement categories to calculate those ratios. And if you have information in the wrong category, it can distort the calculation of those ratios. And then another common error is just adjustments or classification errors. And these are just when, you meant to put something in office supplies, but you coded it to meals and entertainment. And that would be a classification error where it just got stuck in the wrong category or the wrong account. And so when we're doing financial statements, if we notice something that looks really out of whack, we'll try to get that corrected to make sure everything's in its proper classification. Or sometimes we have to make adjusting entries or adjustments to the financial statements to calculate things such as depreciation, which a lot of clients don't do, but we do. We have the software to calculate those adjustments, and we can include that into your financial statements. And that summarizes or completes the financial statement section of our workshop. Here's my information. If you have any questions, feel free to contact me, and I appreciate it. Thank you for that.
Phil, thank you. That was absolutely incredible presentation. I want to say to our audience out here that financial statements is an absolutely crucial element of running any business. You're going to need it for any bonding issues. You're going to need it for any banking issues. So what you just heard from Phil is incredibly valuable. Please note his contact information. And again, if you have any questions, please type them into the chat session. If you have questions for Phil, and we will deal with that a little bit later. Next up is Mr. Andrew Marquis. Again, Andrew is our bonding expert. He is the Vice President and Branch Manager of Markel Surety. You're up, sir.
Thank you for the introduction. I just want to echo what Clotilde said and what Phil added. I can't say enough about how important financial presentation and financial statements and the picking of the right CPA are to the process. They are a key business partner working on your behalf to put your information in the best light possible. I am tasked today with giving you some details about the basics of various contract bonds, specifically bid, payment, and performance. I wanted to begin, though, by providing a little background into suretyship, how surety is different from insurance, and why bonds exist. As you can see by the first slide, the concept of suretyship is nothing new. For centuries, reaching back to the beginnings of civilization, individuals have assumed the responsibilities for the obligations of friends and others. You think about it as a three-party relationship and more in the nature of a credit transaction. As you can see, there are comparison here between surety and insurance. There's little nuances and key differences. I wanted to comment, unlike insurers, sureties do not expect to suffer losses. This may be unrealistic, but it is an underlying principle of suretyship and is the expectation of the surety. The other fundamental difference between surety and insurance is that sureties demand reimbursement from their principals and indemnitors in the event of a loss. Next slide. So what is a surety bond? The intention of it is to prevent financial loss to the secured party. You'll hear this a lot throughout this presentation. It's also known as the obligee, the beneficiary of the bond. Next slide. So how do surety bonds work? So when a surety underwrites payment and performance bonds, what it's doing, it stands behind the contractor's promise to, one, perform the work according to the contract terms and conditions, upstream protection to the obligee, if you will, and then payment to certain subs, laborers, suppliers, also known as downstream protection afforded to subs and suppliers working on that particular project. In regards to why do bonds exist, in light of the risk of construction, the federal government and all 50 states require that construction contracts of a certain size be bonded for the purposes of pre-qualification and to assure successful completion of those public construction contracts. For example, at the federal level, the Miller Act and related regulations require that construction contracts of $150,000 or more be secured with a performance and payment bond. Legislators have determined that it is sound public policy to protect taxpayers against the excess costs of defaulted construction projects. The passage of the Miller Act prompted the passage of similar laws in all 50 states to achieve the same ends on those funded construction projects. Next slide. Regarding indemnity, this is something that the sureties expect a contractor to be all in. We expect contractors to, resolve any problem situations that come up. However, sometimes things occur, and in an indemnity agreement, the principal agrees to reimburse or indemnify the surety if the surety must pay the obligee for the principal's default. The surety relies on the promises of those who execute the indemnity agreement. The indemnity agreement gives the surety specific rights. For example, in the event of a claim on a contract bond, the surety may have to take any of these actions to mitigate the situation or exposure. Call for cash collateral, take control of the project and equipment, even receive assignment of the balance of contract funds. So, the surety relationship between the principal and surety, it's truly a partnership, and it requires communication and working together. I promise that sureties never forget that we are partners and with our principal, and that 99% of the time we're working together to solve issues or help them defend their position. Next slide, please. I'll now talk a little bit about each contract bond and touch on the items needed for consideration along with the challenges at the end of this presentation, as it kind of all ties back into qualifying for surety credit and each bond type. As you can see, contract bonds are often required, and they have the obligation to perform work or services for others. Several of these types of contract bonds are bid bond, payment bond, performance bond. Starting with the bid bond, these are provided as the basic instrument of pre-qualification. Pre-qualification in this context means that the surety has investigated the contractor sufficiently so as to be convinced that it can safely issue a bid bond on a given project. The bid bond states that the contractor will enter into a contract if the contractor's bid is accepted, and the contractor will furnish whatever additional bonds are required. If the contractor fails to do either, the bid bond specifies the amount called the bond penalty, which may be paid as damages. Payment bond, in its definition, it provides subcontractors and suppliers payment security. Subcontractors and suppliers that have not been paid can seek financial recovery under the payment bond. Performance bonds, conversely, provide assurance that the project will be performed in accordance with the terms and conditions of the contract. It helps to provide the project owner the certainty that qualified contractors are hired to perform the work. And second, that financial protection is available in the event of a contractor failure. As you can see on the next slide, there are multiple unseen services of the surety, as mentioned in this presentation already. Next slide, please. So what information is required to secure these bonds, these types of bonds, excuse me? So a surety underwriter considers a variety of factors to evaluate a bond applicant's ability to perform its obligation under the bond. There's an old adage in philosophy called the 3 C's of underwriting, and that's capital, capacity, and character. The surety underwriter will assess the capital factor by reviewing the contractor's financial information, be it corporate financial statements, work in progress schedules, personal financial statements, so on and so forth. Here, the surety must determine if the contractor has the financial wherewithal to support the project. The surety also assesses the contractor's operational ability to perform successfully the contract being bonded. I refer to that as capacity. Here, the surety will analyze information pertaining to the contractor's experience regarding the type and size of the project being bonded, information pertaining to the talent and expertise on the contractor's staff, and information regarding the sufficiency of its equipment. Lastly, in assessing the contractor's character, the surety essentially must make a judgment regarding the contractor's innate ability to keep its commitments. The surety makes this judgment by analyzing credit reports, conducting reference checks, and when appropriate, conducting in-person interviews with the contractor. The scope of the surety's review is broad and is in the context of assessing the contractor's ability to complete successfully not only the project being bonded, but its entire backlog. Experience has shown that project difficulties do not happen in a vacuum, but rather a bad job affects the other projects in the backlog. We're tasked with determining whether the contractor is capable of executing its business plan over the long term. The broad scope of the review also means that the review is ongoing and is not a one-time occurrence. As long as the surety contractor relationship continues, the surety will assess continually the contractor's abilities by reviewing updated information on a periodic basis. Next slide, please. Next slide. Oh, I'm sorry, there we go. So some common challenges in securing these types of bonds. Financial statements. As previously discussed by Phil, the quality and accuracy of the financial statements can potentially be challenges because think of them as scorecards. They demonstrate how well a contracting firm is performing. They also show the resources available to the firm to continue to operate and to mitigate or absorb risks or mistakes. So when we're unable to unscramble the financial information, and it makes it very challenging for us when we don't have an accurate portrayal of your financial condition in order to make risk decisions with our balance sheet as your partner. Capacity to perform is another key challenge. Track record, references, business plan. The objective here is furnishing the information to show that you have the ability to manage as well as construct. It demonstrates the capabilities of the firm, the experience of its people, and your ability to do the business. Lack of staffing, equipment, experience, not a track record in a particular line of construction. Those are things that we have to address and determine if it makes sense for all of us to pursue that job. Again, something that will be discussed in the next part of the presentation, sufficient financial strength. It takes money to do everything, but it takes some people more and some less to do these things. The amount of money required can depend upon the type of work being performed or the organization performing it. Therefore, an evaluation is made of your financial ability to carry out your business plan. Next slide. Oh, I'm sorry. Other comments I want.
Andrew, excuse me for the interruption. Andrew, you are muted.
Thank you, Cotil. Other comments that I wanted to make, as you can see, project size, years of data kind of suggest that taking on bigger work outside of acceptable ratios can be a challenge. Geographic expansion is another one. If you're a Texas-based contractor going to do a job in California, that might be something we're going to have a conversation about. Next slide, please. In closing, some tips that to maximize your surety credit and your ability to secure bonds. I cannot echo this enough, how important frequent, candid communication with your surety is. We are your partner. It is our job to educate and help you take the necessary steps to maximize your bonding. So if we don't have the roadmap, not aware of any transitions into new lines of construction, it's hard for us to be able to provide our resources and assistance to try to help you achieve your goals and execute your plan. As you will hear shortly, protect your liquidity. Cash is king. I would also end with saying that if you don't have the cash to buy the equipment, or do you really need it? Being debt adverse will go a long way to assisting you in protecting your liquidity and assisting with cash flow. So just some things to think about in closing. Again, want to thank you for your time today, and look forward to speaking with you again soon. Thank you.
Andrew, thank you very much. Again, guys, this whole bonding issue is critical. You're not going to do business with any public entity and not have to encounter securing bonds, especially as a prime contractor going for a prime contracting opportunity. So please take note of this information that Andrew has brought us today. Go back over it, study it, become familiar with it. It is incredibly helpful, and we want you to succeed. Okay, next we are going to hear from Mr. Michael Williams. Now, I want you to note that at the beginning of the presentation, I talked about today's topics, and of course, surety bonds is one of our three topics. What I did not say at that introductory slide was a fourth speaker that we are very happy to have today, Michael Williams. Now, Michael is the procurement supervisor for the Capital Contracting Office at the City of Austin. As we thought through our presentation, yes, it's important to hear from these industry leaders with tips on how to get all of these documents you need, all of this information, all of these instruments that you need. But of course, you also need to know what the City of Austin requires of their for their projects. And if you're bidding their projects, no one better to share that information is Michael as the procurement supervisor of Capital Contracting, because they set the terms, conditions, requirements of everything that has to do with bidding projects with the City of Austin. So we definitely want Michael to share a little bit today about what the city requires with respect to bonds. Michael.
All right, good morning, everyone. I'll be going over the bid bonds, the payment and performance bonds for city requirements. The bidders must required to provide a bid bond of 5% of the total bid amount with each bid. A bid bond gives the city assurance that the bidder has the financial means to perform the project with the bid amount. The city has the right to keep the 5% of the bid bond if the bidder fails to enter into a contract with the city for the required bid amount. The bidder will obtain a bid bond from the surety. Once the contract is awarded, bidders are required to provide payment and performance bonds in the amount of the contract prior to the contract execution. The bidder will obtain both payment and performance bonds from a surety. Surety guarantees that the contractual obligations will be fulfilled in the event of the contractor's default. Payment bond ensures that subcontractors are paid for the work performed in the event of a contractor default, and subcontractors file a claim within the required time frame. Performance bonds ensuring that performance bonds ensures project completion in the event of the contractor's default. Thank you.
Appreciate that, Michael. Appreciate that. So our last speaker for today, as we begin to wrap up our presentation and get on to the questions that you might have, we're going to talk about working capital. Again, critical element of any business's success is having access to working capital. And for this, we have an absolute pro, Ms. Barbara Boetta. Barbara is the executive director of the Economic Growth Business Incubator and has a real talent, expertise in working with small, minority, women-owned businesses and small businesses, period, or any business. Barbara.
Thank you, Clotilde. And I want to thank everyone for having me. Just wanted to let everybody know that the three topics that you're learning about today, each presenter can go on probably an hour. So we're crunching a lot of information into a short period of time. But the important thing is to make sure you connect with somebody, some sort of financial advisor, to get this information. It is key for all businesses to have an accounting system and not just putting receipts in a shoebox and waiting till the end of the year to get your taxes done. When you reach the level where you are going to be working with government contracts or big contracts like this, you need to have accurate and timely financial statements. And as Andrew said, you can't, it's very hard to get bonding or surety without any sort of financial statements to review. It's also hard to successfully complete these contracts if you don't understand what your working capital is. And that's what I'm here to talk to you all about today. So working capital is the money that your business uses for day-to-day operations. Okay, this is the money that's in the bank. And we, in our personal lives, manage cash flow a lot. I can't pay this bill yet because my rent or my mortgage hasn't gone through. We've all done that. I'm going to put this on my credit card so I can have a little bit more time paying for it. That is managing cash flow. Now, whether it's managing it correctly or not, that's a different thing. But that's how you manage cash flow. And what we're really going to focus on is short-term working capital. So the money that you need, again, for day-to-day operations. And what you should not use this money for is to buy big purchases. And by that, I mean equipment or a vehicle or some real estate. Those items is what you would use long-term working capital. So like a traditional loan or, part of that money that you have in your account for your savings that you've been saving for a long time. And the reason why you need working capital is you need to understand what your cash flow is. And so cash flow is how money goes in and out of your business. And it's very important to make sure that when you are bidding, that you understand what your cash flow is. So if you all can go to the next slide, I can show you a fairly confusing, and I'm not used to doing this via Zoom, but this is a projection for working capital. And what I've done here is I have made a scenario that we are going to have a contract for $51,000. And if everything goes as planned, we will net $9,700. This will be our profit after we pay our materials, after we pay our fixed expenses like our rent and our payroll, that's admin payroll, our office supplies, all of that. We hope to earn $9,000 in in profit. Now, with working capital and with cash flow, the contracts that you all are going to get into, they have terms. They have 30-day terms, and we hope and pray that you get paid within 30 days, but sometimes you can get paid in 60 or in 90 days. And this is when you need to look at your cash flow so that you can understand how much money do I need to have in the bank to meet my daily expenses so that I do not bounce checks. Because we all know the second we bounce a check, any bank is going to start charging us. And now it's like $30, $35 for every bounce check just from our bank. Now, the other bank may also charge you. So these are things that we have to look at. So in my scenario, what I'm saying is I started this contract with only $1,000 in my bank account. I start my work, and the first month I bill $10,000. But if you see here, when I get that money, I'm not going to get $10,000, my invoice, because my GC is going to keep a retainage. And in my example, for simplicity, I did 10%. So if I'm on a 30-day term, I bill $10,000 with, and 30 days, which is month 2, I get $9,000, right? But that first month, I still have to pay my employees. I still have to buy supplies. I still have to pay my rent. So here, what I did is I said, for my first month, I had $5,500 worth of cost of goods, materials, and labor, and then $2,500 in fixed expenses, which would be rent. That's $8,000 when I add those two that leave my bank account. $8,000 left my bank account, of which I only started with $1,000. So now I am in the hole. I am red, negative $7,000. And again, NSFs are starting to come. In month 2, I bill $8,000, but I'm not going to get those $8,000 till month 3. I get the $9,000 that I invoiced in month 1, but I still have to pay my expenses for month 2. So I have $6,300 that's going to leave my bank account. I have a positive cash for the month because $9,000 came in, $6,300 went out. But when I add month 1 and month 2, I'm still negative $4,300. In month 3, I'm going to bill $15,000. My $7,200 comes in from month 2, but because, and most likely with you all, Even though I bill my most, I'm going to spend the most. So $11,000 is going to leave my bank account in month 3. I have a negative net cash for the month. And here's the big one. We have $8,100 that we are in the hole. We have negative. In month 4, my 1,300 comes in with, once they take out the retainage, I'm still negative. I do not become cash positive until month 6. In month 6, I've already finished. I'm out. And then I do not get my retainage in my example until month 12. So in order for me in a 30-day scenario to avoid getting NSFs, I need to have this $1,000 plus this $8,100 at a minimum in the bank. Now, all of you all are in construction, and this is in a perfect situation, and that just doesn't happen. Something will happen. Something will go wrong. Prices may go up. You may have a longer period that you have to rent something. So we want at a minimum $9,100. But if it were me, I would want $15,000 in my bank account, so I have a cushion. Now let's look. This is my lowest point here. Now, if I go on a 60-day terms, which means I do not get my money for 60 days with the same retainage, I now need $17,000. That's a huge difference. Where am I going to get this money? I only have $1,000 in my bank account. So you have to do this scenario. It doesn't matter that, yay, I am going to make a $10,000 profit. It doesn't matter. What is going to happen to your cash flow? And I loved that Andrew, and I believe Philip said it a couple times, cash is king. And this is a perfect example where you all can see how if you don't have sufficient cash in your bank, you can very quickly be underwater. And so if we go to the next slide, I can show you where to get some working capital. Clear all that. So how do I attain working capital? Well, there are 2 types of working capital that you can look at. The first is a traditional loan. And this is when you start your business and you truly need that injection of money. And for this, I recommend you talk to your financial advisor or your business coach to look at how much money does my business truly need, regardless of if I'm working on a project or not. Because what happens if we start our business underfunded, we can get into our trouble very quickly. There's also a line of credit. And one of the things with lines of credit is this is meant to be short term. So you invoice the city of Austin, you invoice your GC. The second they pay you, you use the money to pay that loan down. So it's very short term. You want your line of credit to go up and down, just like you would a roller coaster. Okay. Lines of credit, and you can ask any accountant and you can ask any banker, lines of credit are historically misused because it's easy cash and, oh my gosh, I got this great deal for this piece of equipment. I have $20,000 on my line of credit. I'm going to pay it off. Well, the thing with a line of credit is that they are 12 months long. So your lender can literally say, it's 12 months, I need all my money. And if you don't have it, then you've just cut yourself off of that loan. There are 4 nonprofit lenders. If you feel that your credit doesn't meet perfectly with the bank requirements, there are 4 nonprofit lenders here in Austin. We are blessed. There is Big Austin, BCL of Texas, Lift Fund, and People Fund. These are 4 nonprofit organizations that are here within the city of Austin to help you grow your business. They realize that life happens and their terms for their lending criteria is a little more flexible than a traditional bank. You also have factoring companies, and factoring companies, they do serve a purpose. I don't want to say they don't, but one important thing about a factoring company is before you get in, you want to make sure you understand how to get out of factoring. This is a very expensive form of financing. I highly recommend you talk to your financial advisor before you get into this, because one of the things with factoring companies is that they'll tell you it's only 2%, that's all they charge you, but that's not true. At the end of the day, you can wind up paying between 20 and 30%. With factoring companies, what you are doing is you are selling your invoices for pennies on the dollar. Like I said, it's not my favorite form of financing, but it does serve a need. And a lot of people say that factoring companies are payday loans for small businesses. They serve a need, but you need to have a plan on how do you get out of a factoring company. And then the final place to get working capital is family and friends. It's hard to ask family and friends how to get to lend you money, but most likely it's going to be the cheapest because they're probably not going to charge you interest, or if they charge you interest, it'll be a very low rate. So these are things, but in order for all of this to work, in order for your business to be successful, you have to talk to your financial advisor. You have to know who your banker is or your lender is in order to establish the relationship to get the funds that you need. And so I think that's the last slide that I have, but I just encourage you all to please reach out to me here at EGBI or any financial advisor to make sure that you are successful. Thank you.
Excellent, Barbara. Absolutely excellent as usual. Erica, do me a favor. Go back to Barbara's spreadsheet slide. Right there. Thank you. The one thing, so I want to say to the audience, so I happen to also be a contractor, construction contractor like you. What Barbara has shown you here is vital. It's absolutely vital. It's kind of like, you know, the good news is you got the contract. Yay, celebrate like I did when I got my first big contract. The bad news is I didn't even have the 1,000 in the bank. Okay, her 1,000 in her hypothetical here. So by the time I got to month 4, you can go ahead and triple that in terms of me being in the hole. It is not a comfortable place to be. Maybe you've never been there. I hope and pray you never be there. I've been there. And if you're not able to keep going and pay for stuff, here's what happens in month 5 that Barbara didn't put on here. You're gone. You're out of business. Bye. So you have to really do your planning way in advance and get all of these sources lined up. Talk to people now. Don't wait until you need it. Talk to them now. Talk to Andrew now. Talk to Phil now. Talk to Barbara now. Much better to get all this stuff lined up. We are done with our presentation, and now we do want to give you an opportunity to raise any questions. I don't see nary a question in chat, but hey, I'm learning Zoom like the rest of you, but if you'll look at the bottom of your screen and go to the little little caricature that says reactions, and you click on that, you'll see the raise hand function. Now, it may be different on what you're looking at. That's where mine is. But what I would invite you to do now, and I do thank all of our speakers today, is to take advantage of the few minutes we do have left to come up with or share your question. And by the way, you know, if you're like me and my experiences in this business stuff, you don't know what you don't know. And so sometimes you don't know what to ask a question about. Um, what bothers me is when folks say, well, I didn't ask that question because I thought it was a dumb question. As far as I'm concerned, there aren't any dumb questions, just there are dumb answers, but there are not any zero dumb questions. So you're here, you joined today because you wanted to learn more about this. If you don't have a question today, that's okay. There's some on our very last screen here. We do have contact information if you would like to reach out to anyone for anything that you would like to raise a question about. We invite you to do that. By the way, I don't know if we mentioned it before, but we will make this presentation available on 2 city websites, the SMBR website and the Corridor Program Office, CPO website as well. Actually, you'll get an email from Nakia James, who is with SMBR. You have probably seen emails from Nakia before, but Nakia will alert everyone once these presentations have been posted at both websites and available for you to review. So I am going to, again, are there any questions? If so, raise your hand. We will unmute you, or you can unmute yourself and pose your questions. Do I have any questions? Going once. Going twice. Thank you, speakers. Thank you, attendees. We appreciate it. We want you to be successful in your pursuit of all of your business opportunities, but in particular, this Corridor program is one of the most significant efforts the city of Austin has ever undertaken. And the city simply will not be able to do it without our local players getting involved and engaged. So if this is something that fits your business model, take a look at this information, reach out, whatever questions you might have. Promise we'll help you with those questions or do our best to do that down the road. But until then, everybody have a fantastic rest of your day, and we'll see you next time. Bye-bye.